Gold is making headlines once again, surging to recent highs and capturing the attention of investors worldwide. With prices climbing and markets filled with uncertainty, everyone seems to be asking the same question. What is really driving gold's latest move? Welcome to Capital Prism, where we explore the intricate tapestries of global economies and decode modern markets. In today's video, we're diving deep into the critical factors behind gold's recent surge. We'll explore the hidden forces influencing investor sentiment and uncover why gold has regained its allure as a safe haven. But first, as investors, there are some key questions we need to ask ourselves. What's fueling the renewed global interest in gold? How sustainable is this latest surge? And most importantly, what does it all mean for your investment strategy moving forward? Stay tuned as we unravel the answers to these essential questions right here on Capital Prism. The gold market's recent surge isn't happening in isolation. It's closely tied to a much larger issue, the global debt crisis. Today, global debt has reached unprecedented levels, surpassing $300 trillion and continuing to grow at a worrying pace. From the United States and Europe to Asia and emerging markets, sovereign debt is ballooning, creating immense economic pressure and uncertainty. The escalating national debt is closely linked to rising interest rates, which significantly increase the cost of servicing debt through higher interest payments. As debt grows, confidence in national currencies and economic stability weakens, driving investors to seek safer assets. And historically, gold has consistently proven itself as one of the most reliable safe havens during times of economic distress. Since the 2008 financial crisis, historically low interest rates allowed the U.S. government to borrow extensively at relatively low costs, fueling increased spending and higher debt levels. However, with current interest rates significantly higher, the government faces growing risks, including the potential for debt default or falling into an unsustainable cycle of issuing new debt simply to cover rising interest payments. Investors see gold as a hedge against currency devaluation, economic instability, and inflation, all direct consequences of excessive sovereign debt. As global debt continues its upward spiral, the rush toward gold is likely only just beginning. To truly understand the dynamics propelling gold's recent surge, we must examine the long-term trajectory of the US dollar, a currency that, over the past 200 years, has experienced a significant decline in purchasing power. In the early 19th century, the dollar's value remained relatively stable. However, as the nation faced events like the Civil War, World Wars, and the Great Depression, the dollar's strength fluctuated, often diminishing during these tumultuous periods. A pivotal moment occurred in 1971 when President Nixon ended the dollar's convertibility to gold, effectively dissolving the Bretton Woods system. This Nixon shock marked the transition to fiat currency, allowing for more flexible monetary policies, but also introducing greater susceptibility to inflation. Since then, the U.S. has implemented monetary policies that have expanded the money supply. While these measures aim to stimulate economic growth, they often lead to inflationary pressures, further eroding the dollar's purchasing power. For instance, between 2000 and 2021, the U.S. money supply, M2, surged from $4.6 trillion to $19.5 trillion. This persistent decline in the dollar's value has led investors to seek assets that can preserve wealth over time. Gold, with its intrinsic value and historical role as a hedge against currency devaluation, emerges as a preferred choice. Unlike fiat currencies, gold's limited supply and universal acceptance make it a stable store of value, especially during periods of monetary instability. In essence, as the dollar's purchasing power wanes due to inflation and expansive monetary policies, gold's appeal intensifies, offering investors a reliable alternative to safeguard their wealth. The global economy has been rattled by escalating trade tensions and unpredictable tariff policies presented in the first few months of 2025. The United States, under President Trump's administration, has imposed a series of tariffs targeting major trading partners, including Canada, Mexico, China, and the European Union. These measures have not only strained diplomatic relations, but have also introduced significant uncertainty into the global market. This climate of unpredictability has taken a toll on economic confidence. Businesses, uncertain about future trade policies, have become hesitant to invest, leading to delays in expansion plans and hiring. Consumers, facing potential price increases on everyday goods due to tariffs, have grown more cautious in their spending. Such sentiments are reflected in the recent plunge in consumer confidence, which has reached its lowest point in over 2 years. Amid this turmoil, investors are seeking refuge in assets perceived as safe havens. Gold, renowned for its stability during periods of economic instability, has emerged as a preferred choice. The precious metal recently surpassed the $3,000 per ounce mark for the first time in history, underscoring its appeal in these uncertain times. This phenomenon, often referred to as a flight to quality, occurs when investors move their capital from riskier assets to more secure ones, like gold. The current trade disputes and the accompanying economic uncertainty have amplified this trend as market participants seek to protect their wealth from potential downturns. Speculation that American businesses are preemptively purchasing commodities ahead of tariffs have also been discussed. Silver refineries are currently averaging a 3-month backlog, indicating far higher demand than usual. In recent years, central banks worldwide have been significantly increasing their gold reserves, a trend that has profound implications for the global financial landscape. In January 2025 alone, central banks reported net purchases of 18 tons of gold, with countries like Uzbekistan, China, and Kazakhstan leading the acquisitions. This aggressive accumulation of gold is driven by several strategic factors. Diversification of reserves. By adding gold, central banks aim to mitigate risks associated with holding large amounts of US dollars, especially amid geopolitical tensions and economic uncertainties. Hedge against inflation. Gold serves as a safeguard against inflationary pressures, preserving value over time. Geopolitical considerations. Nations like China and Russia are bolstering their gold reserves to reduce reliance on the US dollar, thereby enhancing financial sovereignty. Amid these developments, there are discussions within the BRICS nations, Brazil, Russia, India, China, and South Africa, about creating a new currency potentially backed by commodities, including gold. This initiative aims to establish a more stable and autonomous financial system, less dependent on traditional Western currencies. In the United States, similar considerations are emerging. The Treasury Secretary has hinted at exploring the feasibility of backing the US dollar with commodities, including gold, to strengthen its value and counteract inflationary trends. This proposal reflects a growing interest in commodity-backed currencies as a means to enhance economic stability. Federal Reserve Chair Jerome Powell has also contributed to this discourse by acknowledging the possibility of a world with multiple reserve currencies. In a recent congressional testimony, he stated, "It's also possible to have more than one large reserve currency." This perspective underscores the evolving dynamics of global finance and the potential shift towards a multipolar currency system. Collectively, these trends indicate a strategic move by central banks to fortify their financial systems through substantial gold acquisitions. The exploration of commodity-backed currencies by both emerging economies and established powers signifies a pivotal shift in the global monetary order, with gold playing a central role in this transformation. In an ambitious move to streamline federal operations and address mounting fiscal challenges, the Department of Government Efficiency, or DOGE, was established on January 20th, 2025, by an executive order from President Trump. This initiative aims to modernize federal technology and maximize governmental efficiency. DOGE's primary objectives include modernizing federal technology, upgrading outdated systems to enhance productivity, eliminating waste, identifying and reducing unnecessary expenditures, streamlining bureaucracy, simplifying processes to improve service delivery. DOGE seeks to create a more efficient government that better serves the American public. Despite DOGE's efforts, the federal deficit remains a significant concern. Recent data indicates that federal spending reached a record $603 billion in February 2025, overshadowing the savings achieved through efficiency measures. Experts caution that while reducing waste and improving efficiency are commendable, they may not be sufficient to address the structural issues contributing to the national debt. Significant deficit reduction would require cutting deficits by about $900 billion per year in the coming decade. The global financial landscape is undergoing significant shifts, with discussions about the US dollar potentially facing competition as the world's primary reserve currency. This evolving scenario prompts a closer examination of gold's role in a multipolar currency world. Let's take a look at implications for gold during USD competition and geopolitical shifts. Diversification of reserves. As countries explore alternatives to the US dollar, there's a growing trend toward diversifying reserves. Nations like China and Russia have been increasing their gold holdings, aiming to reduce reliance on the dollar and enhance financial stability. This shift could elevate gold's prominence in international reserves. Emergence of alternative currencies. The BRICS nations, Brazil, Russia, India, China, and South Africa, have discussed creating a new currency backed by a basket of commodities, including gold. Such developments could challenge the dollar's dominance and potentially increase global demand for gold as a stabilizing asset. Geopolitical tensions. Ongoing geopolitical conflicts and shifts in global alliances contribute to economic uncertainty. Historically, such periods have driven investors toward gold as a safe haven asset, bolstering its demand and price. Economic policies and inflation. Unconventional monetary policies and rising inflation rates can erode confidence in fiat currencies. In response, both institutional and individual investors may turn to gold to preserve wealth, further increasing its demand. Thanks for joining us on Capital Prism, where history and economics intersect. Don't forget to subscribe and stay curious.